Thanks, Jim. So we had one question that was submitted privately, but I think it's one that you could address relatively quickly, and that might also help clear up any questions that the person asking it maybe had about Roth IRA gifts. So this person says, how do Roth IRA gifts work if the recipient does not have an income? I'm thinking of children who are still in school or grandchildren who are under 18 years old. So I think we're going to assume that it's not an inherited. I think they're saying that they wanted to gift one to someone without an income. And I think you could probably answer that.
Yeah. I have bad news for that person. So in order to make a IRA contribution or a Roth IRA contribution, you have to have earned income. So I don't care what your age, what your balance of your accounts, anything else. If you don't have earned income, you can't contribute to an IRA or a Roth IRA. Now, for most of our clients, even the ones who are retired, they already have existing IRAs or 401ks. So we're not making new Roth contributions, we're making Roth conversions. So let's say that this guy or woman has Roth IRAs, is interested in getting Roth IRAs to his kids and grandkids, but they don't have any earned income. Well, there is no great strategy other than having those kids get a job. And by the way, I talked about consulting with your kids. I actually am not a big fan of, let's call it, sham income. And I know in the literature, they're paying babies to model. They're using that for earned income. And then we're having grandparents make Roth IRA conversions to a 2-year-old who modeled. I would not mess with that. You don't want to do, that's not comfortable for me. To me, that kind of crosses the line. I don't mind going, I don't want to go right up to the line, but, I'm a taxpayer advocate, but something like that goes too far. But there is no great answer other than having those kids have some earned income. Now, if you give them some chores and you say, well, you mow my lawn, or you help me with the dishes, or you do something and I'll pay you, well, then that's maybe a different story. But there's other than that, there's no easy answer for making a gift and having the beneficiary put money in a Roth or a Roth IRA or a Roth 401k if that beneficiary doesn't have any income. The natural thing to do if the child is young is, instead of putting it into a Roth, would be to put it into a 529 plan, which is really taxed very similar to a Roth. So you're taking, let's say, IRA money, you're paying taxes on it, you're left with some after-tax dollars. You put that after-tax dollars in a 529 plan for the benefit of the grandchildren. The money in the let's say the grandchild's 5, and let's say the grandchild isn't going to use it until they're 18, and even at 18, they're not going to use all of it. They're just going to use, say, 1/4 or 1/5 of it. So we get maybe 13 years of tax-free growth, or even maybe 20 years of tax-free growth. That might be a reasonable strategy. I know it wasn't part of the question, which was Roth, but again, I am an attorney. I'm allowed to take any question and answer anything else. And I often will see things that people aren't thinking about because I can't help myself. Okay, why don't we go to the next one, Erica?
Well, also, Jim, I think you're not giving yourself enough credit there. I think you answered the person's question, but you also answered the underlying question, which was really about how they might be able to gift tax-efficient funds to their grandchildren. And a 529 plan is definitely a great option for that for a lot of people.
It is. And by the way, after I meet with people, I do these long memos. They're often several pages, which is the beginning of the master plan. And Erica is off, and we get them transcribed professionally by a real person, by the way. And then it goes to Erica, who often edits it. And she's, by the way, she is pretty heavy with the red ink, but it's always it comes out more clear. So her technical knowledge is much better than you would expect from somebody in her role. But anyway, go ahead.
Well, thanks, Jim. The other question that I wanted to ask next is another one from prospective client. but it piggybacks on the question that you were answering prior to the question that I just asked, talking about what to do if you're asset rich but after tax dollars poor, and you want to do Roth conversion. So prospective client said, would you suggest getting a secured loan from a brokerage company on personally owned securities at under 2% to pay the taxes on a Roth conversion?
So again, we don't have the money to pay the tax on the conversion. And I said one of the things that I like is to find a tax-free source of funds in order to pay the tax on the conversion. And I mentioned a home equity loan as something that it might not be comfortable, but it might be more comfortable than a margin loan. So conceptually, is it the same thing? Yeah. Is it a reasonable thing to do? Oh, yeah. Will it pass the stomach test for most people? Probably not. But again, same idea. I'd obviously want to look at the terms of the loan, et cetera, but it's a reasonable idea. And I'll tell you what I like about the last two questions is that both of these people have what I call larceny of the heart. Actually, it's not my term. It's a guy named Ernie Dell. He was one of my law professors. I went to Duquesne, and and I was a CPA at the time. So I started out as a somewhat seasoned CPA going to law school, and I took every tax course that they offered. And one of the great things about Duquesne, and I was in the night school because I was working my way through. I was working for Arthur Anderson, Buchanan Ingersoll. Arthur Anderson is no longer, but they were a terrific CPA firm, and I was in the tax department, and I was in the tax department of a big fancy law firm. But anyway, Ernie Dell, he was with Reed Smith, one of the big fancy firms, and he and Tom Arbogast and Dixon Rich and some of the Pittsburghers will recognize these names. These are like some of the top, tax estate attorneys in the city, and they would be adjunct professors at Duquesne, where I was going to school at night. So they would work during the day and typically walk to Duquesne at night, which is exactly what I did. They were the teacher, I was a student. And anyway, Ernie Dell, he was a funny guy. He used to say, the worst enemy of the young lawyer is the book salesman. Legal books are to be read, not purchased. So anyway, he was very big on, let's take a look at the entire picture and make some appropriate plan from that, both from a tax and a legal perspective. And that question might be one that that Ernie would like, because again, there's tax implications, legal implications, stomach implications, etc. Okay, didn't mean to get diverted with the story, but I do remember some of these guys very clearly.
No, it's fun. And if we didn't, well, you know what, it's great, even though we do have a bunch of questions. So the next question comes from Kurt in Grove City, which is a suburb of the city I grew up in, Columbus, Ohio. So hi, Kurt. His question was submitted before the webinar, and it's about the Secure Act. And he says, does the 10-year rule of the Secure Act only apply to beneficiaries who are individuals? When a beneficiary is a non-individual, such as a trust, must the inherited IRA be distributed within 5 years of the original owner's death per IRS regs?
Okay. All right. So first, let's talk about what's going on when another story, can't help myself. So I'm reading the Wall Street Journal, and they were talking, and the article started talking about the complications of how most estate attorneys botch the 5 conditions that are necessary in order to qualify as a designated beneficiary of an IRA once you are gone. So, and they were 100% right. Most estate attorneys do botch the trust that is meant to receive an inherited IRA at death. And then they said, so the conclusion is, if you have a big IRA, don't name a trust as your beneficiary. And I'm like, no, that's such stupid advice. The right advice, instead of, sometimes you need a trust as the beneficiary of an IRA. We're going to talk more about that tomorrow. But maybe the beneficiary is a spendthrift. Maybe the beneficiary has special needs. Maybe the beneficiary, unfortunately, the trust that is gaining in popularity more than any other, we even have a name for it, is I don't want my no good son-in-law to inherit 1 red cent of my money trust. Most of my money's in an IRA, so what do? Well, a lot of times you need a trust. So to say don't put it in trust, that was a terrible idea. So I'm all flustered, and I write a letter to the Wall Street Journal. Dear Wall Street Journal, I don't like the advice that you're blah, 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 blah. Okay, so I sent it in. Then that day I had a radio show, and a guy named Bruce Steiner was a guest. And Bruce is a very smart estate attorney from New York City. And anyway, Bruce gets on the phone, and I just started, how are you, Bruce? And he says, I'm furious. What's the matter, Bruce? Well, I read an article today in the Wall Street Journal, and it said when the underlying asset is an IRA, don't name a trust as the beneficiary of the IRA, and that's such stupid advice. The right advice is just to find a estate attorney that knows what they're doing, that will insert the 5 conditions as the beneficiary of the IRA, and that way you get your cake and you eat it too, meaning you get the tax benefits for the beneficiary, and you still get the benefits of the tax protection. And that's actually what I want here. Now, the 5-year rule is, I don't even want to get into that, but I'll just say, if you get it right, you get the trust right, and it's not rocket science, you just have to know it. I think Matt, who looks at these, says that between 90 and 95% of the estate attorneys botch this, including attorneys, from big fancy law firms downtown that, I don't want to say anything bad about anybody, but attorneys that should know better, or if they don't know better, they should say, we're not experts in this area. If you came to me and you said, hey, Jim, I have a $10 million business. I want the business to go to my son, but I want to figure out something to be fair to my daughter. How should I would say, hey, that's not my area. If, on the other hand, you have a couple $1 million IRA and you say, well, my son's doing great, he's very high bracket, my daughter's not doing great, then I'm going to get interested in doing Roth conversions and who gets what and blah, blah, blah. So anyway, I guess the big picture on that is you can have your cake and eat it too. You just have to make sure that you go to an estate attorney who understands the 5 conditions in order to qualify as a designated beneficiary of an IRA. And by the way, if the trust is because you have a special needs or a chronically ill beneficiary, you're not only saving the stretch for 10 years, which is the normal amount for just a plain old beneficiary, but you might be saving the stretch for their entire life. And that can be the difference on $1 million IRA between the disabled kid being broke later in life or having $2 million later in life. So you want to get these provisions right. But even the difference between getting it right for the 10-year, that can still be tens or even hundreds of thousands of dollars difference. So we want to get that right and insist. And if you're interviewing a state attorney, say, do you know about the 5 conditions in order to qualify as a designated beneficiary of an IRA to get the stretch? If they start going, let me think about that. I think it would be safe to say, well, gee, thank you for your time. It's time to do it for somebody else. Because they should know that. And to me, anybody who's working with people with the IRAs, they should know that. On the other hand, it's easy for me to say, but I'm telling you, hardly anybody gets this right. And by the way, now it's even worse because the strategies have changed in the last 2 years. And I'm not going to get into this because I've already overextended this question, but we used to do what were called pass-through or conduit trusts, and now we're doing accumulation trusts with different strategies. And I won't get into all that today. I'll do more of that tomorrow between 10 and 12 when I talk about trusts and when the underlying asset is an IRA. So anyway, why don't we go on to the next one?
Well, and that statistic that Matt gave you about how many of these trusts that he sees that have botched language, also for me reminded me that that's a wonderful reason why anyone who's requesting a retire secure consultation today or anytime in the future definitely wants to submit your estate planning documents for review so that Jim and Matt can see what's going on with your trust to make sure that yours are drafted correctly, or in what's more likely tell you that they need to be changed or redrafted.
No, you're right, Erica. Because if they don't send in their tax return, they don't send in their will, there's or trust or beneficiaries of IRA. There's two possibilities. One, I'll say, hey, they didn't fulfill the requirements of the consultation. I don't want to talk to them at all. Or two, I will be talking to them with one hand tied behind my back. And I don't like either of those solutions. So it is best to submit all the information for the consultation. Thank you, Erica.
So the next question came to us privately in the chat. So I won't use a name, but they said, I have equal assets in 401k and taxable accounts. I don't need income from the taxable account. Why not leave all taxable assets into stocks, get step up in basis at death instead of paying ordinary income tax to convert 401k to Roth? I don't know if that's an example of larceny of the heart or...
No. So first of all, the questioner might be depending on a law that's never going to be part of the law when he dies. He's referring to the step up in basis rules. You buy something for $1, goes up to $10, you sell it, capital gain of $9. You buy something for $1, goes up to $10, you gift it to your kid sells it, he or she has a capital gain of $9. This is the step up in basis rules. You buy something for $1, goes up to $10, you die. Your kid sells this stock the day after you die for $10, there's no capital gain. So the question is, why not leave the after-tax dollars that will, under the current law, get a step up in basis and don't bother with the Roth? Well, first, the Roth, the ordinary rates are historically and probably even with some changes are still likely to be much higher than capital gains rates. Second, and maybe even more importantly, and depending on your age and depending on what happens with Congress and who knows, but I would be willing to bet without any more information. I would bet $1. That's what my friends and I do. We bet $1 and the loser holds it up and the winner snaps it. But anyway, I would bet $1 that the step up in basis rules is not going to be the applicable rule of law at the time of the questioner's death. And I don't even know the questioner's age. If you're in your 60s and 70s, counting on the step up in basis rules, I think I would not call that a great bet. I would, and here's the problem, and it's a real problem, because now I get this a lot of the old engineers or people that work for a company and they know the inside of the company and they love the company and they think the stock is going to be out of sight, and it's sometimes 10, 20, 40% of their portfolio. And this is really more the money management side than me, but the money manager is saying, hey, you have way too high a concentration. It shouldn't, most of the general rule of thumb, you don't want more than 1 or 2% of anything to be part of your portfolio. But of course, they understand, they maybe plan to diversify it over time or whatever it is. But a lot of these folks say, oh, no, it's going to go to the moon and I'm going to die and my kids are going to get this wonderful step up and it's going to be terrific. And then what happens is two things. One, it doesn't go to the sky because it's just a stock like any other stock. And two, they end up dying after the step up in basis is repealed. So it's really not a good strategy. And they've lost safety, and most of our older clients, safety is very important. So anyway, long-winded answer, I'm not a big fan of counting on the step up in basis. So I would rather plan an appropriate Roth IRA conversion strategy. Now maybe you're being a little bit more conservative because instead of paying it with plain old after-tax dollars, he's going to have to cash in some of his highly appreciated stock, sell that, incur a capital gain. So now you have to play with both tax with capital gains and Roth IRA conversions. So I suspect when you run the numbers, we're going to end up with a lower recommendation, but that doesn't mean a recommendation of 0. Hope that helps.